Hi everyone, Mark Myman here, coming to you with a 2023 March market update. Wow, what a week. Banks collapsing all over the place. We've had Signature Bank, we've had Silicon Valley Bank, now potentially spreading into Credit Suisse and First Republic. And this is a developing story. Seems like every day is something new. But it's been a very rocky road for the markets. Interest rates, when things like this happen, interest rates tend to go down. So we've seen interest rates dip a little bit, which is a nice silver lining. But basically what's happening, for those that aren't familiar with this story, is that when banks collect deposits from people, what they do is they go and either lend that money out or they invest it to try to make money off of the spread, which is the difference between what they give to the consumer and what they can either lend it out at or invest it at. And the problem is when you have a lot of people trying to withdraw money at the same time, which is what's been happening, these banks don't have enough cash on hand to actually give people their own money. So they try to borrow it, but the problem is they secured it at such low interest rates, and now the interest rates are high, so they're having to take massive losses. So the dollar for dollar value is significantly diminished. So they don't have enough money to be able to give people back their own deposits. It's kind of a crazy phenomenon, but that's how banking works, and that's how banks make money, is by reinvesting other people's funds. So we're definitely seeing the markets react to this. It's been a nice little dip in interest rates, but seemingly every day is back and forth. So just a matter of trying to catch it on a good day. Where we're seeing it affect things on the mortgage side in a little bit of a negative way is in hard money loans, which we'll talk about in a second, and also non-traditional financing. Those markets are starting to tighten up. They're getting a little nervous about the stability of the economy and their ability to get paid back on these loans. We have not seen it spill out in the traditional space quite yet, but on the non-traditional space, that's where we're seeing the biggest impacts. So as far as rates, what's going on with rates, we've obviously seen some reaction based on all these bank collapses. That is an ongoing story. If that continues, we will definitely see the acceleration of interest rates going down faster. We're also starting to see inflation continue to move downward, and as inflation goes, mortgage rates go. So as we continue to see inflation dropping, mortgage rates should drop as well. We're also seeing that Fannie Mae and Freddie Mac had planned a new pricing adjustment, meaning higher rates for people that have debt-to-income ratios over 40%. They have just recently decided to push that off because the mortgage industry was fighting that pretty hard because there's extenuating circumstances sometimes, and it's just a very difficult thing to manage for lenders. So Fannie Mae and Freddie Mac, FHFA is the group that manages those two. They've decided to push that off a little bit and rethink it. So we're hopeful that that will actually go away. So we'll see what happens with that. But rates are definitely a bit of a moving target. So our product spotlight for this month is hard money loans. So hard money loans tend to be kind of a last resort. They're very expensive. They're high rates and usually high points, but they are able to close on transactions that otherwise you just wouldn't be able to close on. So what does that mean? It's usually things like irrevocable trusts, properties that are not inhabitable as is. Maybe somebody's doing fix and flip financing on an uninhabitable property. There's all sorts of circumstances. Reverse 1031 exchanges are another example. People investing with their money in a 401k or an IRA, call it self-directed IRA or 401k. They can accommodate these things that traditional lenders don't allow to do, and often what they're used for is what we call gap financing. So they get the property to the point where it's in condition where somebody can get a traditional loan. They're not designed to be long-term. They're meant to be short-term plug, and they're very effective in these situations where you just can't get lending any other way. Obviously, if you could, you wouldn't want those terms that a hard money loan would have. But it can be a really great way to overcome some of those common challenges that we see. Even though they're expensive, they are a way to potentially get over those hurdles. So if you have any questions, this is definitely financing that we can offer, and we do actively That market is starting to dry up a little bit, so be mindful of that. The terms may get even more expensive if the markets continue to contract, but we'll see how that goes. Some important dates coming up. March 21st and 22nd is the next Fed meeting. That's going to be a really interesting one because the Fed is in this real big pinch. Now that these bank collapses have started to happen, they may not be able to raise rates as much as they were hoping to this next meeting. So we'll see what happens with that. Depending on which direction they go, that could move interest rates up or down. So we're definitely watching that very closely. And then the next inflation report, which is also something we're watching closely, is April 12th. However, mark your calendars, May 10th. That is the date when we expect the acceleration of rates going down because inflation is expected to go down more rapidly following that period. Here's the reason why. Inflationary reports are based on a 12-month rolling average. So if you look back 12 months ago, those are still including months at the tail end of that period where inflation was really high, right? And as we go further in time, those months are going to drop out of the average, and inflation has been getting better. So just based on the technical nature of how the inflation numbers are reported, as those higher inflationary numbers drop off of the back end of that 12-month cycle, we will see the average or the reported number for the CPI index, which is the inflation reading, also dropping off. Now, May is an important one because that's when those big, heavy inflationary months start to drop out of that calculation. So keep your eyes on that date, May 10th, mark it down. We're having these discussions with clients to say maybe you want to wait if you have enough time before closing. You may want to wait for the next inflationary reports and to see how things shake out with the banking collapse, because you may end up seeing lower rates, or we may be able to float down a rate if it's already been locked. So other things, what are we up to and how can you engage with us? So I'm really excited to show you guys this. This has been a labor of love, something we've been working on for a very long time, but you're looking at the very first published version of the New York Buyer's Guide. Now we are going to be creating these for California and other states as well, but this was our first shot at it. This is literally the very first copy that's been printed. And if you or your agents are interested in getting this, it has some great resources in it. It has checklists at different stages of the process. It has information on how to assemble your financial team, not just for the transaction. Most people assume that once you close on a property, your work is done. In our opinion, that's when a lot of the new work starts. So lining up a financial advisor, an insurance agent, life insurance, estate planning, all those things become more important when you own a home. So this will help you assemble that team. And it has a bunch of worksheets that you can use while you're out there searching for properties and your clients are engaging with you. It's a great way to track progress over time. Talks about the process of pre-approval, what documents are needed. It's very comprehensive. It's almost 100 pages. So if you're interested in getting some copies for your clients, please let us know. We are also about to launch very soon the On the Mark podcast. Funny, here we go, play on words. On the Mark podcast will be available on all the streaming services relatively soon. Keep an eye out for that in the next 2 to 3 weeks. And we're really excited about that. We're also continuing to get great feedback about our Financial Wellness Forum, which is where we invite clients to come in and listen to discussions that we have with professionals from different financial worlds. We mix in a little bit of real estate, but it's really meant to help clients sharpen their financial pencils and become more well-rounded financially. It's totally free. Anyone can sign up, agents, managers, clients. If you want to add it, offer it as a value add to your client base, by all means, we welcome everyone. We just feel like this is information that needs to get out there, and most people are not getting proper financial advice, and we want to give them a platform to be able to learn from that. So we hope to continue to collaborate with you. Feel free to reach out if you have any questions or scenarios you want to discuss with my team and I. It's going to be a very interesting month, to say the least, and we are happy to help guide you and your clients through that process. So take care and see you next month.